Sampro TV and Global Money Talk are delighted to have Omotunde Lawal on the show today. Omotunde is a managing director and head of EMEA corporate credit at Barings, based in London. Barings is a global asset management firm with over $470 billion in assets under management. Previously, she was a managing director with Babson Capital Management. Tunde is a CFA charter holder and a chartered accountant. She holds a Bachelor of Science from the University of Warwick. Tunde, thank you so much for joining us today.
Thank you for having me.
It's really a treat to have somebody who can and talk about credit. With investors talk about stocks all the time, but as we know, the bond markets and the credit markets overall are a bigger part and perhaps an even more important part of the economy. So, can you start by giving our viewers just a very general overview of corporate credit overall and in EMEA? Like, how big is this market, say, compared to government debt, and what are the biggest markets?
Okay, so generically, the corporate credit market is quite large. And when we talk about corporate credit, it's corporate credit across US investment grade, European investment grade, emerging market corporate credit. And then you've obviously got the high yield segments of those markets as well, US high yield and European high yield market. Within the US investment grade market, I think you're looking at a market that is probably about a sort of 8 trillion size market. And on the European side, that's probably a little bit smaller size, which is probably about equivalent of about $3 to $4 trillion dollar equivalent market cap. And then on the emerging market side, the corporate credit universe is somewhere around 2.6 trillion. So it is quite large in the context, but obviously dwarfed by sovereign. The US Treasury market is dwarfed by very many of these other sovereign local markets as well. So, you think about how much the Indian government or Chinese government or US government or all these other governments have. So the local currency rates market is much larger than the corporate credit market. And these numbers that I've quoted you are actually the hard currency corporates market. There's a very large universe also of local currency corporates market, which we tend not to invest in, but it's also a very large number as well. And it's actually much larger for emerging markets, for example. It's much larger than the 2.6 trillion that you have in the hard currency emerging market corporates.
Is that so? I didn't realize that, and I guess approximately, if it's 2.6 in hard currency, approximately what would the local currency be?
Local is probably high single digits. We're looking at probably 7 to 8 trillion dollar equivalent, and that's because if you think about the way certain of these emerging markets are structured, their domestic capital markets function sufficiently that a lot of the funding happens domestically. You think about the Indian market, for example. India has a very deep domestic rupee-based corporate credit market that supplements the bank lending market, and therefore it's very large. And you have pockets of emerging markets here where you have quite developed domestic capital markets, and that tends to be emerging market countries that have a developed pension framework or insurance market framework where they're local asset managers or pension funds that need to buy local currency assets. So you think about Chile, Peru, India, China, Korea is another one, places like that where there's a deep domestic capital market. That's where you tend to find local currency corporate bonds. Brazil increasingly in the last few years has also started to develop its domestic capital market, and you're starting to see BRL denominated debentures grow as an asset class.
I've had some emerging markets background, but it is way shrouded in the mists of history. So would it be accurate to say that the rates that for local currency corporate debt would be substantially higher than hard currency corporate debt because you're taking the currency risk, and you're taking the currency? Would that be accurate?
It depends. It depends on what the local in the interest rate in the local domestic market is. And very many times we will see corporate issuers who have the option of either issuing in the domestic capital markets or coming to the international dollar market. When they speak to their bankers, they look at the funding costs, both onshore and offshore. And some of them will do that arbitrage. Sometimes, depending on where the rates are, it's cheaper to fund offshore. Sometimes it's cheaper to fund onshore. So Brazil is a very good example. For the best part of 2024, we didn't have a huge amount of corporate supply out of Brazil. And that was because it was cheaper to fund onshore for those guys because the BCB, where the rates were, it was cheaper because a lot of these debentures will price off the domestic rates. And then as we started to see yields come down and rates get cheaper in the dollar market, 2025, we've seen a lot more Brazilian corporate issuance coming through because it's a little bit cheaper to fund offshore than it is onshore. We see the same thing with the Indian corporate issuers as well. Very many times, they will check what the cost of funding is onshore versus offshore. And where there's an arbitrage, they will come to the dollar market instead of doing it onshore. The other thing that factors into that decision will be the tenor that they want. Again, domestic capital markets, as developed as they are getting, you oftentimes won't get long tenor in these markets. So you might get 3-year, 5-year type tenors. Sometimes you will get 10-year, depending on which country and how developed it is, but you might not get a 30-year tenor funding in the domestic capital market, but in the dollar market, you can get that. So again, it's an offset between pricing and the tenor that you want and the type of features that you want.
That's fascinating. A deeper market that we'll have to dive into hopefully when we have you on again. So here, a question for me, and again, it shows my relative inexperience with the corporate debt market is, how is corporate debt priced? Is it generally priced as a spread to the relevant government debt if it's local, and to treasuries, or I suppose to to a European central bank benchmark if it's issued in euros? How is it priced?
That is generally how it works. So for the hard currency market that we tend to invest in, if it's US dollar denominated, we're pricing off of treasuries, and that's how we typically would price it, because the treasury yield curve is the assumed risk-free rate globally, right? And so whatever you are pricing in US dollar, you're pricing it as a credit spread over treasury. So if I'm a single A rated company and I want to borrow in US dollars, the market might say, actually, your credit risk, it's worth maybe 20 basis points over US Treasury. But if you are a single B rated corporate issuer, the market might demand 400 basis points over the US Treasury for the particular tenor that you're looking to borrow from. And so that differential is what your perceived credit risk is. And that's essentially what the team and I are doing, is trying to assess that credit risk and what that credit spread is worth, and whether we're getting paid for that credit risk that we're taking. Just to finish off here, if you're borrowing in the local currency, yes. So the example of Brazil, you will price it as a spread over the BCB rate. If you are pricing a euro-denominated bond as well, you will price it over bunds. Very many of the euro-denominated bonds that we see is priced off of mid-swaps. But again, when you quote it, you can quote it over bunds.
Right.
And if it's UK, it's quoted over gilts. So yes.
I wanted to just go back with something you said. I was just thinking about your answer to the fact that if you have longer term, sometimes you're better going off an international hard currency issue rather than a local issue. And it sort of my immediate thinking was, wow, when the local people, the local market understand risk better. But I guess, is it an inflation issue over if you've got a 10 or 20 or 30-year bond that there's more demand internationally than locally? Because I guess, my immediate sense was, I thought that would be the opposite.
Not necessarily. So longer tenor borrowing in the offshore market doesn't necessarily mean that the locals don't understand the credit. It's just about the risk appetite and how frequently you need to turn over the capital, right? If you think about banks generally don't lend long term. Banks will do RCFs, which are maybe 12-month tenor, or they might do term loans, 3-year, maybe 5-year tenor. And that's because the banks, their return on capital, it has to be turned over quite quickly, and therefore they can't afford to tie up huge amounts of capital for 10 years or 30 years. And sometimes in the case of some corporate borrowers, they borrow for 100 years. We have some century bonds, right? And so you don't see banks tie up capital for that long. So that tenor issue is really about scarcity of capital in the domestic capital market and how long these lenders want to tie up that capital for. Whereas in the international capital market, because it's a huge pool of capital and you have lots of diversification of underlying investors in it, there are some investors who in some of the funds are insurance companies, and they generally are trying to match their assets with their liabilities. So they particularly want long duration exposure. And therefore, those types of investors want asset managers like us to invest in long duration bonds, 30-year bonds. So there's a natural matching of borrowers that might want longer dated borrowing versus investors that want to lend for a longer time period because they need to match the assets to the liability. But it doesn't mean that the locals don't understand the credit risk as well as the offshore guys. It's literally just about matching what you need with where the availability is and pricing, obviously.
In terms of, I took a look. I tried to look at the Fed website, the St. Louis Fed website, and they had a nice chart about sort of weighted spreads to to treasuries, and spreads seem to be pretty tight, have gotten pretty tight. Is that generally true globally, and if so, why?
Generically, credit spreads are optically close to tight levels across all asset classes. You speak to people, investment grade, developed market investment grade, developed market high yield, emerging market investment grade, emerging market high yield. And there's several reasons, but I think before we even delve into reasons why spreads are optically at tight levels, I think you need to look at when we talk about yields and we say spreads are tight, but yields are high. If you think about what the components are of yield, it's that risk-free rate. And then on top of that risk-free rate, you have credit spread, right? If credit spreads stay here, but the risk-free rate has gone from here to here, right? Credit spreads just go on top of that, right? And so your yields look like they're going higher and higher. But actually, what is happening is it's the component of the within the yield, it's the risk-free component that's going up. So actually, your contribution, the percentage of credit spreads within the total yield, hasn't changed dramatically over the last, say, decade or so. We had a look at a chart not too long ago internally, and we were seeing that contribution of credit spreads to total yield, it stays relatively similar or stable at relatively similar levels. So when we say that yields are high and yields are decade highs at the moment, it's really that risk-free component part that has moved up. And that is why it does seem like the spreads might be a little bit more compressed, but actually the contribution of spreads within the total yield has stayed relatively stable. Now, to come to credit spreads within themselves, how do they look to history or to previous history within themselves? Yes, we're a little bit tighter. I can use emerging markets specifically, which is more my area of specialty, as a reference point. So credit spreads within EM at the moment, if I quote the index level, is currently about 190 basis points, right? Post global financial crisis tights of credit spreads were probably about 178, right? So we're close to the all-time tights, but not at the all-time tights. And if you think about where we went to the wides, when we went to the wides, Russia-Ukraine invasion, China real estate sector issue, or even more recently, Liberation Day in April of this year, those spreads went close to about 400, right? So yes, they've come in. Are they lower? Yes. But are they at the all-time tights? No. Within all of that, even though when I look back to history and it says, yes, we are close to all-time tights, within all of that, I can see that there's been an improvement in the underlying quality of the companies and the corporates that make up that index level spread number. If I think about all the companies that have fallen out of the universe of the index, a lot of the Russian companies, a lot of the Chinese companies, they've all defaulted, they've all fallen out of that. So actually what you're left with is a quality bias within the index. And so you're getting better quality and stronger companies that remain within the universe, but those spreads are coming down to reflect that actually underlying quality of these companies are quite good. The other thing that we've seen that explains why these spreads are justifiably where they are is because post-COVID, we've seen a lot of companies within emerging markets, they've actually been run a lot more conservatively. So the amount of debt that they have on the balance sheet is much lower. A lot of them have slightly higher cash balances. A lot of them have brought down their cost of funding. If you think cost of funding went up a bit and it started to come down because during COVID rates were quite low. So a lot of companies refinanced their borrowing and they brought down the cost of funding. So actually corporate balance sheets are quite healthy. The number that I like to quote is the average leverage within emerging market high yield bond universe. And that average leverage is something like 2.4, 2.5 times, which means for every $1 of profit that you're making, you only have about $2.50 of debt. To that. And when you compare that to the equivalent US company, the US company has a higher leverage. It's about 3.6 times. So companies in the US are still run a little bit more debt compared to companies in emerging markets. So actually, on the face of it, even though the index tells you the spreads are at 190, you're getting better quality companies, more conservative balance sheets. You're getting companies that are more global in their footprint, right? If you think about the last decade, how much prosperity and growth you've had in emerging markets. A lot of the companies that now come from emerging markets are more global. There's a lot more interconnectivity despite this renationalization that we're seeing and reshoring. A lot of the companies, it might have your headquarters in Brazil, but you're selling to China, you're selling to Europe, you're selling to Africa. You're more global in your footprint, actually, and you are more reminiscent of a developed market company because actually a lot of your exposure or end exposure is to developed markets. So actually that's justifying, these are some of the things that justify why the spreads are tighter where they are. But again, in context of what percentage these spreads are contributing to the total yield, that percentage of contribution has stayed relatively stable.
That's fascinating. That a lot of these emerging markets are less indebted than the U.S. But then I guess the U.S. has always had a love for debt and a love for leverage. And when it works, it's great, and when it doesn't, well, it's survivorship bias in the index, I guess.
Exactly.
So I have a question. If you have a client who's interested in, I'm looking for X amount, X amount of yield, they're really looking at that graph that you show. I guess I'm doing it wrong. More like this. It's really more like the other way. I think the camera is messing with me a little bit. But they're really thinking more about.
Goes like, yeah.
Yeah, they're thinking more about the overall risk-free yield is contributing substantially more than the corporate. So would it be accurate to say that getting corporate, international corporate or EM high yield debt is just a kicker over what you're getting anyway, and that's why they're saying, if I'm an insurance company and I can get, 190 or something a little smaller if it's investment grade, 100 basis points over the risk-free rate, they're grabbing for that, for that opportunity. Is that accurate?
I mean, so the way generally works is there's a huge pool of money out there in the world, right? And generically, people try to cluster around the risk-free rate or where they think there'll be the most preservation of capital, and that tends to be clustered around the risk-free rate, which is why you'll see, a lot of investment into government bonds, be it the US or bunds or CGBs, which is a Chinese one, or JGBs, Japanese ones, because people think their governments are the closest they will get to risk-free within their environment. And then you add on certain investors will be seeking a particular yield target because maybe they have liabilities on the other side that they need to match and they need to generate a return on that investment. And so, you'll get people seeking different rates of return, which then means that they chase different asset classes. The next layer down would then be the money market funds, which again are very close to sort of risk-free rate in terms of it being as close as you can get to maybe a cash equivalent. Money market funds, very high quality, relatively short dated. And then people will move up different asset classes towards the risk spectrum all the way through to equities, right? All the way at the end. Emerging markets generally benefits because it tends to be in that yield seeking asset class. So when rates are going down in the US and the money that generally sits or would be parked in money market funds or treasuries is looking for a higher rate of return, it will seek out higher yielding asset classes such as high yield or emerging markets. And that's where we benefit from it because we then offer a pickup, a spread pickup or a yield pickup to the risk-free rate, which is the point that I was making earlier, is when you look at the credit spreads at the index level is what 190 at the moment. So this is telling you that we are 190 basis points over the US Treasuries for similar duration profile. And if you looked at the high yield component of our market, for example, the high yield component of our market, you're getting a spread of about 370. And then in the US high yield market, that spread is somewhere just inside of 300 at the moment, I believe. And again, different parts of the world. So again, depending on what it is that is your objective, your investment objective, and the type of return that you're seeking, there are always different asset classes to target or a basket of different asset classes to target, which you can then blend. You can have some of it in sovereign bonds, you can have some of it in corporate bonds. Within corporate bonds, you can either be on the investment grade side or you can be on the high yield side. There's a flavor for every taste, as it were.
Just a quick question for so my viewers can understand the terms. So investment grade, I guess, is BBB minus and upwards. What is high yield? Like, what is the universe of high yield in terms of like general ratings?
When we say investment grade, we're really talking about anything that's rated higher than a triple B minus. So triple B minus, triple B flat, triple B plus, single A rated, double A, and then triple A rated. And when we say high yield, it's everything from a double B plus and lower. And that's generally how we think about it. And that's just the rating agency convention of how they think about that. And that's really mapping to what your perceived credit risk is or credit quality is. So the general consensus or rule of thumb is something that's a single A rated should be better credit quality than something that's a single B rated. It's the difference between you having a credit card that has £1,000,000 limit on it and a credit card that only has £100 limit on it. That difference is your credit risk. And that is reflected in the credit ratings.
So in the accessible universe today in terms of corporate bonds, accessible to the your general international investor, whether by ETFs or some kind of fund, where do do you see value in terms of either spread or overall yields, and what who do you think is sort of cheap, and who do you think might be sort of near the top of the band, and you might perhaps think about, if you own some of that paper, maybe rolling that paper into something that's that has more potential?
I'd say generically, where we see tight spreads at the moment would be in regions where they're relatively quite well insulated to tariff noise. There is a deep domestic capital market and a deep sort of domestic buyer base that buys the bonds there, and markets that are probably still growing. And when I think about which markets exhibit all three, it's really the Middle East GCC at the moment. And so we see quite tight spreads generically within the Middle East GCC. You think about the big economies there, the Saudi, the UAE, there's big transformation projects going on. There's big transformation going on to structural shift from hydrocarbon denominated economies into more diversified economies. And within that, there's a lot of domestic sponsorship of local buyers buying those bonds. It's a region that's relatively stable, relatively insulated from tariff noise and all the noise. And so spreads are tight there. We also see tight spreads in certain parts of Asia as well. China, for example, within the China tech space, spreads are quite tight there again, and China financials and tech. Again, spreads are tight there because the policy banks in China and the large domestic investors tend to buy what they're familiar with, and so they will buy the bonds of the policy banks, as well as these tech names like the Babas and the Tencents and things like that. When I think about areas which trade tight, there'll be areas that have particular catalysts that make for tight spreads, and that would be perhaps being more insulated from tariff noise. It'll be areas that have their own idiosyncratic tailwinds, and it would also be areas that have quite a large, deep domestic buyer base, a regional buyer base that makes it quite resilient in terms of spreads. And when I think about which region ticks all three boxes, I think the GCC and the Middle East is really a part of the world that ticks all those boxes. Spreads are quite tight there. You think about the transformation that's happening at the moment in Saudi Arabia and the United Arab Emirates, where there's a structural transformation of these hydrocarbon economies into more diversified economies. That is making for a lot of, and they're very highly rated as well, very strong economies in themselves. And so that makes for quite a sticky investor money that buys these bonds, which keeps the spreads quite tight. Apart from the sort of things, apart from them being insulated from the rest of the tariff noise and all these other things. And another pocket that we see quite tight spreads in is the China financial sector and the tech sector. Again, very similar in that it's a little bit more insulated within itself, and there's a very sort of dedicated buyer base that will buy those bonds. The large policy banks and the large asset managers in the region buy these sort of Babas, Tencents, and the sort of Chinese bank bonds because they know that they are state-backed. They're solid money good type investments, and so that keeps the spreads tight as well. Away from those two pockets, I'd say that we see other regions, you can find pockets of value in other regions. India, for example, within India, we find pockets of value in the more high yield segment of the market, where you see a lot more renewable power projects coming through. And these tend to be double B rated, so high yield rated. And so there you can find some pockets of value, although that sort of value has dissipated probably over the last year or two. But then you look at the investment grade part of the India corporate market, and actually that's quite tight because, again, that's a lot of policy banks, a lot of state-owned banks, a lot of the large conglomerates like the Reliance and the Tata, where, remember I told you earlier, India is a large domestic capital market where they fund domestically. And so there's a lot of the pension funds, a lot of the insurance companies are buying these bonds. So it keeps that quite tight. But Latin America, on the other hand, some of these economies that are newer to developing their capital markets, like Brazil or Argentina, Guatemala, places like that, you can still find value. Mexico is quite developed domestic capital market, but even within pockets of Mexico, you can still find value. Things like Pemex, where it trades cheap for what it is, although it's a government-owned entity. And then you have within places like Colombia as well, you can find pockets of value. Argentina, the Vaca Muerta development in Argentina, which is their unconventional field, oil and gas field. Again, lots of corporate supply coming out of there where you can find value. So there's lots of pockets of value that we find across countries and across sectors.
That's we really have to be quite nimble, and I like the fact that you said in China there are certain sectors that are sort of tariff resistant, that will do, that they're going to be stable and do pretty well. On that note, as you look across, sort of a volatile world today with a lot of issues, and certainly as volatile a U.S. president as many of us have seen in recent memory, if not ever, as a corporate bond strategist, what keeps you up at night? Are there certain event risks or certain elections, perhaps, that that you watch very carefully, or things that are upcoming in the next weeks to months to or 2026, where like I'm going to keep an eye on this because this could have if it goes other than expected, it could have a major impact.
Absolutely. There's a lot that keeps me up at night, I'll tell you that. um, I'd say credit risk, because we are in the business of assessing credit risk, and credit risk, just with the ebbs and flows of the market. Are we at the top of the cycle, bottom of the cycle, close to the top of the cycle? Credit risk will present in different ways. At the moment, we're starting to get certain sort of skirmishes around the lower quality end of the market. If I think through to end of September, early October, we saw pockets of emerging markets high yield space show some credit stress. We had a couple of companies that went into distress that are headed for restructuring or bankruptcy in Brazil. We saw in Turkey, there was a crackdown on corruption, which affected some of the companies. So things like that give me some cause for concern, because, is it showing me that we are close to the top of the cycle where high interest rates is starting to cause credit stress to some companies, or are they isolated incidences? You hear about situations like the First Brands and you worry whether, although that can't or isn't necessarily something that we expect to see within emerging markets, because these types of structured products that was behind the First Brands doesn't necessarily exist within emerging markets. But again, you worry about the sort of credit cycle constantly. Geopolitics is a big thing that keeps me up at night. This for 2026, we have several LATAM countries headed for the polls, Colombia, Chile, Peru, that are headed for the polls in terms of presidential elections, Brazil as well. And those have a propensity to bring some volatility if things don't go according to what the polls and the markets expect. And so that's always something to watch. Although I will say 2024 was one of the biggest election years in a very long time across both the developed markets and emerging markets. And actually the surprise that we saw in 2024 was mostly on the developed market side with the US elections as opposed to the emerging market elections, actually. So if that were to continue to play out, then the assumption is we shouldn't see too much excitement from elections for emerging markets in 2026, but it's not something we can discount. And then obviously there is always the tension around geopolitics. There's the US and China trade tensions. Does that bubble over during 2026? How does that play out? There's the AI race and the tech dominance race as well. Will that create unintended consequences in 2026? These are all the kind of things that keep me up at night and that I have to be thinking about and trying to look around the corner for.
Well, you brought up tech, and we were having a conversation earlier. Sort of Facebook had this jaw-dropping sort of $30 billion issue that they talked about, and it seemed to be quite oversubscribed. A lot of demand for it. Just some thoughts on that. I know it's not EMEA, but what are your thoughts on that?
I think everyone was very excited watching the book on the Facebook, and it was very interesting because they ended up doing 30 billion, and I believe the overall books were something like 120 or 130 billion. So it was a ridiculous size order book. But in context, why we found it funny was in context, this one company issued $30 billion in one transaction in one day as a drive-by, which means they didn't even pre-market it and tell anyone about it. They just drive by, as we call it. And that was more than the entire Brazilian corporate issuers had managed to issue through the whole of 2025. They have only managed to issue 27 billion. And this one company on the US side did it in a drive-by deal multiple times oversubscribed. And this just gives you a sense of some of the money that's chasing AI and tech related projects and initiatives out there.
Wow, that's bigger than Brazil in a drive-by. That probably even like depressed the treasury market. I'd imagine something that size.
It is all very exciting. It is very exciting. And we had the Chinese government and they issued a 3-year and a 5-year, and we were laughing at that because actually the issuance was supposed to be capped at no more than $4 billion. But they also got books of about 120 billion, and they ended up pricing the 3-year at flat to treasury, so T plus 0, and the 5-year priced at T plus 2, so 2 basis points over the US treasury, which was interesting in itself. If you think about China Inc. story is also very much about tech and AI at the moment, isn't it?
Wow. So were those the Chinese issues? Were those like dollar denominated? Were
They were
Dollar
dollar
denominated.
denominated,
Yeah.
right?
right, right. Wow. So that is huge oversubscription. I guess they don't have that much debt, and people are grabbing for it. Wow. Tunde, thank you so much for your time. I wish we had a little bit more time, but I know you do have to go, and I look forward to having you back again.
Thank you. Thank you very much for having me.